wouldn't be able to tell that this guy has $180 million. He nailed it perfectly.
I am the reaction.
This is Takashi kotegawa. I think that's how you pronounce it. He is one of the most famous intraday traders on the stock market who made millions of dollars in the early 2000 draws nest. To be specific, he traded from just $13,000 to $153 million.
Are you serious right now?
Yes, you heard me right, 153 million, which if you do the math, is a 11,700% gain. And what is even crazier, he did all of this in the span of just 8 years. That SFN insane. How did he find the stocks to enter in? Did he use specific indicators? What strategy did he use? Well, I scavenged the internet for days looking for those answers. Days! And I found some secret site releasing his exact strategy. And I gotta say, it's pretty smart. Since I'm the awesome YouTuber I am, I'm gonna share it with you for absolutely free. Let's get straight to it. Because I think that as one of the easiest ways to become successful at trading is by learning from people who actually were successful at it. Makes sense. So I'm kind of excited about this. I think we can learn a lot from videos like this. So to understand Takeshi's strategy, we first have to understand what type of trader he was. Takeshi had specific conditions he was looking for when trying to find stocks to enter in. He was mainly looking for stocks that were in a long-term downtrend, and his goal was to try to find the bottom of that downtrend to then profit from a short-term reversal. Now, as you may know, finding the bottom of a trend is a lot easier said than done. Actually, it's pretty hard, but with the help of his secret strategy, it raises the odds a ton of you finding the exact reversal point. So knowing that Takeshi liked downtrends, he really liked bear markets. As he stated in an interview, bear markets present the most opportunities, but he also traded in bull markets as well. He just fine-tuned his strategy to whatever the current market sentiment was, which we'll go over how to do that in a little bit. But he mainly preferred bear markets. Now, in the articles I read, Takeshi on average was in his trades for around 2-6 days, but oftentimes he would hold his position for a week or two, depending on the conditions of the market and how volatile it was. But what conditions was he specially looking for? Well, Takeshi actually said this in an interview himself. In the bear market of 2001 and 2002, I would only look at stocks at least 20% below the 25-day moving average, 35% being a somewhat safe level to buy at. The price would then surge, at which point I declose the position at a profit. And he says this cycle would continuously repeat the process where he would then repeat the strategy. But he also said there is a slight problem with this whole concept. Not all stocks are going to react the same. And the sensitivity of the rebound levels greatly depend on multiple factors like market sentiment and the sector you're trading in. For example, a stock is way less likely to bounce at a key level if that day the market is insanely red and everything is dropping. It also depends on the sector. For example, stocks in the tech and biotech sectors are much more volatile than, say, stocks in the utilities sector, which are a lot less volatile and don't move as much. So he said a big part of his strategy was finding the right moving average threshold for specific conditions. For example, you would have a bigger gap on tech companies and a smaller gap on utility companies. So with this strategy, there is not a one-size-fits-all. There requires a bit of judgment from the trader. To help you out a bit, I did some research of my own and ranked the most volatile sectors to the least volatile sectors, consumer and tech being the most volatile, and materials and energy being the least volatile. So just keep that in mind when using this strategy. So now that we all have the conditions for using this strategy, let us move on to how to find the stocks themselves. But all right, so how do we find the stocks themselves? Now, Takeshi didn't really explain this part, but I myself found a great way to do this. We're going to need to go on TradingView. I'll leave a link in my description. We are going to be using TradingView's stock screener. I think you need TradingView Pro in order to use this, but if you don't have that or don't feel like paying for it, there are some free scanners out there you can use instead. But we'll be using TradingView for this example. Once you're on the screener, change the time frame to 4 hours. Go to the settings. Make sure we are only looking at common stock, these exchanges. Price change percent is below 20. Price is above $1. Mark current trading day and price below the 20 EMA by 20%. You can also filter out specific sectors if you want to trade stocks in a specific sector. This will give you a full list of stocks in our criteria. Now, Takeshi said himself, he likes stocks that were gradually downtrending, no sharp movements. So often teams form this biggest losers list. You will see penny stocks that had sharp down movements like this. We want to disregard these stocks. What we are looking for is something like this, where the move is very gradual downwards. Just go through the list and try to find stocks that are gradually moving downwards. Next, we need to figure out the market sentiment. There are multiple ways to do this. Now, we want the market sentiment of the whole stock market, not just the stock we are trading. An easy way to do this is by looking at the S&P 500. To do this, go to MT5, type in US 500. We then want to get a current long-term read on the market. So go to the time frames and make it a higher time frame. like the 4-hour. Once you have done that, check the trend table. It will instantly tell you how the current market is trending. If it's green and says strong long, the market is uptrending. If it's red, it's downtrending. Remember all of this for later, because we will be using it to optimize the strategy. It's even better if you get the specific sector the stock you're looking at. For example, if you are looking at a company like Google, which is in the tech sector, we would want to see the market sentiment of that specific sector. To do this, just find a tech sector fund like XLK, which is measuring only the tech stocks. You then would do the exact same thing we just did, but with just XLK. Check the table and see how it's currently trending. So that S, how you can find the stocks to trade, but what's the actually itself? Go back to TradingView. So we now have the stock we were looking at. It's a gradual downtrend, and we know that stock S sector specific sentiment. We want to add some indicators to the chart. Go to the indicators tab and type in EMRE. Now takashi used very specific settings. So go to the settings of the EMA and change the length to 25. Next, go back to the indicators tab and type in RSI and that to the chart. Then finally, we are going to add one more indicator, and that is the MACD. We can keep these settings at default.
Nice.
So we now have the indicators set up. Now, as said before, Takeshi was looking for a big gap between the current price and the EMA. So we want to go to a larger time frame like the 4-hour. We can then measure the gap between the EMA and the current price. To do this, just go to the toolbar on the left, grab the measuring tool, and mark from the EMA to the price. Now, Takeshi said he would only look at stocks with a gap bigger than 20%, and 35% being more safe. But this is when the trader's judgment starts to come into play. So say if we were looking at the trend table from before and it said bearish, meaning the current market is in a downtrend, we can start to shoot for the larger percentage gaps like 30 or 35%. But if the current market is bullish, we would shoot for smaller percentage gaps like 20 or 25%. This is also when the sector thing comes into play. Same thing if you are in a more volatile sector like tech or biotech, you would shoot for those larger gaps. If you were in a less volatile sector like utilities, you would shoot for smaller gaps. So again, you yourself are going to have to judge what gap you are looking for based on current market conditions. So we found a gradual downtrend, we measured the sectors, and we found a suitable gap. We now move to the next part, which is support and resistances. Go to a larger time frame, like the 4-hour or daily, mark out all the key levels. You should only mark the very strong levels. By the time you're done, your chart should look something like this, with very few lines only marking the major levels. It shouldn't like this, where you have tons of levels and marking weak levels. We only want the major levels. We then wait for price to hit one of these major levels. Now again, this part takes some judgment. If you are in a bear market, price can easily hit one of the higher levels and break, right though it. So we would want to wait for some of these lower, more major levels. If we are in a bull market, price is more likely to respect these levels, and we can aim for these higher, less strong levels. So again, there's some trader's judgment with this strategy, but I personally think that's why it works so well. Next, we also want to look at our RSI indicator and make sure the line is in the oversold area once price is by this support. So now that we have our chart set up, we are going to wait for price to hit these levels and enter into a trade live. Okay, so it's been a couple days and price hit our level. So we were going to take a trade live, so price hit our level, and we are happy with the current conditions. We are now going to go to a lower time frame. Takeshi himself used the 15-minute time frame for this specific part. What we are looking for is price to start bouncing, and we want confirmation that this is happening. So this chart you can see, right before this correction, there was a big gap between the EMA and the price. We are also seeing an uptrend starting to form on the smaller time frame, showing a bounce is starting to occur and the chart is starting to gain momentum. As some extra confirmation, we check our MACD, and it is also showing signs that the market is getting ready to turn bullish by this histogram turning green. Once we get all of this confirmation on the lower time frame, we can now enter the trade. Now, Takeshi said his take profit and stop loss would be dynamic depending on current market conditions. So in a bear market, we would obviously want smaller take profits. In a bull market, we can have a slightly larger take profits. So we enter the trade right here. As it's starting to read us, this now made support on the lower time frame. What I found works really well is setting your take profit at the next highest resistance we marked on the higher time frame and set your stop loss right below the current low. So we now in the trade and we can wait to see price does. A couple days passed, and as you can see, this trade went perfectly as planned, and price bounced exactly where we thought it would and hit our take profit with ease. I think this strategy works extremely well, as Takeshi made his millions doing exactly this. And I think one of the major reasons it does work so well is because it goes off current market conditions, not just a one-size-fits-all strategy like most trading strategies are on YouTube. Try it out, DM on Instagram, and share it with me how it's working for you. Thanks for watching, and I'll see you guys next time.